I'm teaching you to look at this dichotomy. It's how you are to interpret price action like smart money does. By having this mindset, it allows you to frame a context and say, okay, selling above the high here and targeting here, that is what? It's an implied dealing range. Anticipating a beginning of a run here and seeing it trade here for first stage offset distribution. That means partials, they can profit there, they can bank profit, and they provide liquidity at these price points too. So that's the reason why I say all the time that there's not any real necessity for you to be looking at depth of market, book maps, liquidity maps, all those things. All you have to do is know what time of the day you're trading. Look at what it's doing, and just look at where the old highs and lows are. There's a low right here. The same thing is happening. This area of entry to this, and another level would be here. So this, what is this level right there? That's the employment data. So anyone that was trading that, they're going to have orders resting below that. What kind of orders? Sell stops. So they could do another measure of sell stop liquidity, pairing that up with another second stage offset distribution, meaning what they sold short up here and they have left over after taking some of it off here, they can buy that back below that low right there. And it'll be like this. So when having levels in mind like this, when you're looking at price action and you're tape reading it, there's offset distribution right there. So there's two levels with liquidity. Okay, so it's smart money entry, first stage offset distribution. Smart money takes some of their winning position off, and then the second stage down here, and you see them take that there. Okay. Notice that this entire range, and I'm going to have to close it because it's getting too long. So they keep it to an hour maximum, which is fine, I guess. So this is the implied dealing range. Meaning that, let's do an ugly yellow color. There you go. Nice and ugly, but it stands out, right? So we have visually, you would interpret this as smart money going short at the high, okay, turtle soup, and then it trades lower. I told you that this would be your breaker, which is the down close candle between the high, the low, the higher high. This candlestick in here, that's your breaker, and there's your opening price as well. And then you have first presented fair value gap right there, right here. So by having this, it trades up into that, overshoots a little bit. You can color outside the lines, it's okay. And then the market sells off, and then we go into this high resistance liquidity run conditions where you got to just simply wait, just wait. And then the market starts to move lower, and then you can go into the lower time frames over here and look for inefficiencies in price action. Nice one right here. See that little gap right there? Trades to it here, sells off, uses the suspension block from the daily charts, gradient levels here, and then starts to explore lower prices. Once it gets down to this level here, it trades right back up into a gradient level once more there, and a fair value gap, and a consequent correction of this wick, which is half gap theory, same thing as the opening range gap. Trading to half gap, half range, half order block, okay, helps us define whether or not a market is bullish or bearish while a run is underway. Meaning, look at this little wick here. See that wick? If the price can't leave a body above that and it trades from here up into it, but it repels that, is that indicating that it's bullish or bearish? it's bearish. It's extremely heavy. So whenever I see a market that's bearish and it trades up into a wick like this, watch. Okay, so right there's the wick, and this is where it hits that perfectly, and that price is 342.50, and the high comes in at 342.75. So it's one tick off. So that's good enough for government work, right? So it acts just like an immediate rebalance, which is extremely powerful. It's immediate response. You get immediate feedback. In the next candle, you would see it open. You want to see it become aggressively weaker. And does it do it? Yes. Trades up in a small little gap here and breaks down lower and trades down to even more of the gradient levels on that suspension block.